Welcome to Understanding the Basics of 1031 Exchanges. If there's any of you out there that thought by way of exchanges we're talking about a swap meet, you're probably at the wrong webinar. But let me begin by introducing our company. We're the National Association of Real Estate Advisors, and we affectionately call ourselves NAREA. My name's Ken Holman. I'll introduce myself here in just a minute. But we educate real estate professionals and investors all over the country on how to list, lease, invest, buy, and sell real estate. There are two ways to become a member of NAREA. You can join for free as a basic member, or you can sign up as a pro member for $199 a year. All members receive our monthly e-newsletter publication, NAREA News, plus access to our media center and discounts from affiliate partners. The pro members receive some added benefits, like receiving discounts on the Certified Commercial Advisor Designation Program and other educational classes. And they have access to our investment analysis tools, our fillable contracts and forms. They're also highlighted with a personal profile on our website, nareagroup.org. So my name's Ken Holman. I'm president of NAREA, and I'm also president of our company, the Overland Group. We have our company's involved in all facets of the real estate business, including real estate investment syndication, construction, development, management, brokerage, both residential and commercial. I have degrees in accounting and an MBA and several nationally recognized designations. So I thought it might be good to spend just a minute to meet the team that put this together. So let me introduce two of our outstanding team members who have helped with the presentation today. That's Brittany Johnson and Stephanie Sampson. Brittany and Stephanie, why don't you take a minute and introduce yourselves and tell us a little bit about what you do.
Hi, I'm Brittany, and I'm the Executive Director for NAREA. I'm responsible for the day-to-day operation, including managing all sales efforts, ensuring customer service standards are high and continually improving.
And I'm Stephanie. I am the Media Director for NAREA. I oversee all online content creation for the NAREA website, newsletter, and social media pages. My job is to keep the information displayed on our site fresh, informative, and appealing.
So before we get started, my attorney tells me that we should read a short disclaimer. The material contained in this presentation is for educational purposes only. Neither NAREA nor I provide any tax advice, and you need to consult your own experts when you're doing a 1031 exchange. Notice there is a Q&A button at the bottom of your screen, so feel free to type any questions you have and we'll answer them at the end. Also, the presentation is being recorded and we'll add it to our website so anybody that's a member can have access to it at any time, but we will also send it out as a link to anybody who signed on to the webinar today. One other point I might add as we get going here is 1031 exchanges are a little complicated in terms of the type of transaction, but there's a lot of legal language that's we'll need to use today. So I hope that works for everybody. Most people who are just getting acquainted with 1031 tax-deferred exchanges They don't realize that these types of transactions have been around since Congress passed the Revenue Act of 1921. Today, the actual law is found in 26 U.S.C. Section 1031 of the Internal Revenue Code. And under Section 1031, a taxpayer may defer recognition of capital gains and related federal income tax liability on the exchange of certain types of property. This process is known as a 1031 tax-deferred exchange, or simply a 1031 exchange. And these 1031 exchanges are an excellent way to build wealth, a great strategy, which leaves you and your investors that you work with more money in their pocket to reinvest in bigger and better properties. So please understand, however, that the tax obligation is only deferred. It is not eliminated. And here's a quick overview of some of the steps we'll be discussing in our presentation today. First, there's a short window of opportunity when doing these types of transactions. To have them be most successful, you need to decide upfront that you're going to do a 1031 exchange. And that gives you more time to find a suitable property. Don't wait until after the property is sold before you begin the process. You must identify the property, the replacement property that you're going to be involved with well before you're going to purchase it. And as you'll see, there's a limited time frame to close on these transactions. 1031 exchanges are a little complicated, but they're not that difficult. And they can be a little bit tricky if you don't understand the rules and regulations. So let's move forward and see exactly how we handle these things. So there are some rules to follow. The IRS, as you know, absolutely loves rules, but don't worry, the tax code gives you some room to be creative as well. However, three things that we should mention right up front is the title to the old property and the title to the new property must be identical. The owner on title cannot change. So also, if you want to truly defer taxes, all the proceeds must be reinvested. Any proceeds taken out at the time of sale, except to pay title, escrow, and exchange fees, will be taxed. And both the old property, called the relinquished property, and the new property, called the replacement property, must be held for investment. You can't use the proceeds to buy, say, a new primary residence, for example. Both the relinquished property and the replacement property, as I mentioned, must be held for investment or for what's called reproductive use in a trade or business. In general, the law states no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment if such real property is exchanged for real property of like kind. Since most of you are in the real estate business along with me, we're going to spend our time talking about real property held for investment rather than property held for productive use in a trade or business. The phrase held for investment is pretty self-explanatory, but sometimes people have questions about the term like kind. And a like kind exchange has been defined as real property exchanged for real property. In other words, you can't exchange a rental home for a yacht or something else that's not real property. Properties are considered like kind if they're of the same nature or character, even if they differ in grade or quality. And properties are also considered like kind if they're of a similar class. So most legal scholars interpret the term like kind as meaning replacing one real estate investment property for another real estate investment property. So you could replace a single family rental home, for instance, with a duplex or with land or even an office building, a retail property, or an industrial property, as long as you intend to hold the replacement property for investment. To qualify as a 1031 exchange, the replacement property must be identified on or before 45 days after the date the taxpayer transfers the relinquished property. And the replacement property must be received no later than 180 days after the date on which the taxpayer transfers the relinquished property. Some people ask me if the IRS is really serious about the number of days, and I just have to tell you, you better believe they are. 45 days and 180 days are actual calendar days. That includes weekends and holidays. If you miss these dates, I have to tell you, your 1031 exchange is doomed. So make sure you mark these due dates on your calendar and stick to them religiously. Another requirement is that the replacement property must be of equal or greater value than the property sold. Now, what does that mean exactly? Well, it means that the replacement property that is purchased must be worth as much as or more than the property you just sold. If it isn't, there's likely going to be a tax consequence requiring you to pay at least a portion of the capital gains tax owed on the sale. So let's run through a little example and see how all this works. Say you have a rental home, for instance, that you bought for $257,000, and the land was worth $50,000, and the home was worth $207,000. You'll see why I broke out the land separately in just a moment. But when you bought the home, you invested $25,000 of your own cash and borrowed $232,000. Now you've held it for 5 years, and you've been making mortgage payments on the home at $1,100 a month. It's been a lot of work to maintain the property, but you've been able to clear about $250 a month after expenses, which is giving you a 12% cash on cash return. That's not a bad return, by the way. And now after 5 years, you put the home on the market, and within days, you find a buyer who's willing to pay you $310,000. It's your lucky day. Even before you put the investment property up for sale, you knew you wanted to do a 1031 exchange. So you've been looking for a good replacement property that's less management intensive. And over the 5 years, you've taken $37,500 in depreciation. Since it's residential property, you're able to depreciate the property over 27.5 years, but you can only depreciate the building portion of the property, not the land. That's why we separated the land out, so we could calculate the depreciation. And so the transaction looks like this. Starting with adjusted basis, we bought it for $257,000. We didn't make any capital improvements, which is unusual. You normally would have capital improvements. And then you've taken $37,500 in depreciation. So your adjusted basis at the sale is $219,500. You found you've now got the property under contract at $310,000, and you projected there's like a 6% commission going to be paid and 1% in closing costs. So you estimated your projected cost of sale at $21,700, less your adjusted basis of $219,500. That gives you a gain on the sale of $68,800. And some of that gain is attributable to the depreciation that you took, 37.5. You had no suspended losses. And so the capital gain from appreciation is $31,300. Now, let's look at the net sale proceeds. There's really four things we're going to look at in this example. We're going to determine the adjusted basis on the property at the time of sale, which we've done. We're going to calculate the gain on the sale. Next, just for fun, we're going to calculate the sale proceeds before and after taxes are paid. And then finally, we're going to determine the purchase price that we need to have for the replacement property to qualify for the 1031 exchange. So let's look at the net sale proceeds for a minute. The projected sale price of $310,000, $21,700 in costs of sale. Our mortgage balance at the end of the 5th year is $209,838. We don't have any reserves. So our sale proceeds before tax is $78,462. Now, if we're going to pay taxes, we have to pay depreciation recapture taxes of 25%, which is $93.75, and then a tax on the gain on sale of 15%, which is $46.95. So our net sale proceeds would be $64,392 if we did not do a 1031 exchange. However, since we're going to do a 1031 exchange, we have more money to work with. And our replacement property is based on our sale of our existing property of $310,000 less our eligible closing costs. And some closing costs are not eligible, but title, escrow, and exchange fees are. Then we have a net purchase price of $288,300. And that number is the number that your sale has to be equal to or greater than. And then you have $209,838 in debt, and you receive $78,462 in cash. So notice in this transaction, there are two types of gain associated with the sale of the property: gain attributable to depreciation and gain attributable to appreciation. Now, since the IRS permits you to depreciate real property over its useful life, and that amount gets deducted from the income you're required to report, when you sell the property, the government wants you to pay taxes on the depreciation you're permitted to take. And that tax rate on depreciation recapture is 25%. And then the tax on the gain attributable to appreciation is usually 15%. That's unless you're in a really high tax bracket, then it could go up as high as 20%. So in the example that we had, if you decided to not pay or to not do a 1031 exchange and just pay the taxes owed, you would be required to pay $14,070, which is a combination of the tax required to be paid on depreciation recapture and the tax paid on the capital gain attributable to the appreciation in the value of the property. So you were able to take that $14,070 along with the other cash available and invest it all in a new property rather than paying Uncle Sam. And those dollars can work for you, earning a greater return over time. Now, ultimately, if you decide to stop doing 1031 exchanges and just pay taxes, you'll have a larger capital gains tax to pay because you carry the adjusted basis from the old property to the new property. Another thing to consider when you're dealing with a 1031 exchange transaction is the debt associated with the sale. If it's an all cash transaction, then you don't have to worry about dealing with any debt. But if you had debt, meaning a mortgage on the property you sold, to fully defer all capital gains taxes and depreciation recapture due on the sale. Both the equity that you receive and the debt in the new replacement property must be equal to or greater than the equity and debt of the old relinquished property. If you have less equity in or a smaller mortgage on the new property, there will be some capital gains taxes to pay. And let me say, on occasion, there's some question about how debt really works, because when you sell your old property, the cash that you receive actually goes to pay off that mortgage. Well, from a government perspective, you need to carry another mortgage into the new property that's equal to or greater than the old mortgage that you just paid off. Otherwise, your 1031 exchange isn't fully qualified. So there's another term that you'll occasionally run into when you're doing a 1031 exchange. It's a thing called boot. And Stephanie did a nice job putting a boot on there with some cash in it. But it's also called exchange boot. The term boot is not used in the Internal Revenue Code or the regulations, but it refers to the receipt of additional money or other property that you receive in the exchange. So let's say one party pays some liabilities for the other party or throws in some personal property. In either case, there could be some taxes to pay. And there's different kinds of boot, like equity or cash boot or mortgage boot. The calculation of boot is beyond the scope of this presentation, but just be aware that it could happen if you acquire a property that isn't equal to or greater than the property that you're selling, or if you take cash out of the transaction. So that's a little bit about boot. And a qualified intermediary will tell you all about that. So, which brings me to my next point. 1031 exchanges are complicated enough that you should not attempt to do these without having expert guidance. Almost every 1031 exchange is handled by a qualified intermediary who's also known as an accommodator. And this is a company approved by the IRS who is qualified to facilitate 1031 tax-deferred exchange transactions. So make sure that you and your clients use a non-related qualified intermediary when you're doing a 1031 exchange. And this transaction that I closed on yesterday, I had 4 1031 exchanges happening simultaneously. And so we had one title company that was handling the closing, and the escrow officer was experienced in 1031 exchanges. And then we had 4 different qualified intermediaries dealing with 4 different clients. So that was a little fun. So next, let's discuss some restrictions imposed by the IRS on the number of properties which can be identified as potential replacement properties. Because it's possible to have like a sale of your property fall through before you can purchase a property that you've identified, the IRS permits you to identify more than one property, and you could have one of the properties you identify that sells out from under you. So as long as you follow these rules, you're in good shape. So the 3 primary rules we're going to discuss are the 3 property rule, the 200% rule, and the 95% rule. And we'll take each of these separately. So under the 3 property rule, the IRS permits you to identify up to 3 properties regardless of their fair market values. And all identified properties are not required to be purchased to satisfy the exchange. Only the number of properties needed to meet your value requirement. So each of the properties you identify could be of equal or greater value, or maybe not. But at the end of the day, the properties you purchase must in total be of equal or greater value. The 200% rule states that any number of properties may be specified as long as the aggregate fair market value of all the replacement properties does not exceed 200% of the aggregate fair market value of all the relinquished properties as of the initial transfer date. So under the 200% rule, you could have more than 3 properties that you actually identify. And then the last rule that we're going to talk about is the 95% rule, which states that any number of replacement properties can be identified as long as the fair market value of the properties actually received by the end of the exchange are at least 95% of the aggregate fair market value of all the potential replacement properties identified. Well, let's talk a little bit more about these 3 rules because there's often some confusion about them. Each of these 3 rules are exclusive from the others. So most taxpayers use the 3 property rule. It seems the most common by identifying 1 or 2 or 3 properties they would like to consider acquiring. However, if a taxpayer identifies more than 3 properties, they can choose to identify under the 200% rule. And if the 95% rule is selected, the taxpayer still has to identify the properties within the 45-day window, just like you have to do with the other 2 rules. But they can determine the fair market value up to the day of closing or by day 180 of the exchange period, whichever comes first. So it gives you a little time to figure out exactly what values you're talking about here. So to eliminate a lot of confusion between these various rules, most people try to comply with the 3 property rule. Unless they've identified more than 3 properties, you don't have to identify 3. If you got 1 property you really like and you know you're going to be able to close on that, that's good enough. So the 3 property rule is just a safety valve in case one of the properties or 2 of the properties fall out. So anyway, regardless of any of these, it's best to seek the guidance of your qualified intermediary who's really going to help you through this process. So let's review here for a minute. Wow, we've covered a lot of territory in a short period of time. We've covered real property held for investment purposes. We've covered like-kind exchanges, relinquished and replacement properties, time limits for identifying and replacing a property. We've covered the concept of equal or greater value. We've talked about 2 types of gain on sale and how the gain is calculated. We've talked about mortgage debt and exchange boot and the importance of using a qualified intermediary. And then we finished up with the 3 rules for identifying replacement properties. The only thing that we haven't talked about yet is just the basic documents required to do a 1031 exchange. So these are pretty simple. There's a standard real estate purchase contract. Some call it a purchase and sale agreement. And then there are various addendums that usually accompany most real estate transactions. You'll want to add 1 additional addendum, which I usually see, which is the 1031 addendum, where both parties agree to participate in the 1031 exchange. And if there's a mortgage or a promissory note on the property or seller financing, then you'll usually be dealing with a trust deed. But that about sums up understanding the basics of 1031 exchanges. One question you might ask yourself is, why do investors go to all the work of doing a 1031 exchange? Well, I think the answer is pretty simple. It's all about the time value of money, which states that the present value of $1 invested is worth more today than it is if you invest it at some future date. And if you defer the payment of capital gains taxes to some future date, you'll have more dollars to invest today, which over time those dollars can add up to actually a lot of money. Here's how significant I think it is. Say you invested $200,000 today and you can earn 10% on your money. Over 10 years, that $200,000 would be worth $518,000, which is a 259% increase. So say you had to pay taxes, both federal and state, and you wound up only having $150,000 instead of $200,000 to invest. That would grow to $389,000, which is a difference basically of $130,000. That's a lot of money. So the payment of taxes reduces your investment potential in the little example I just gave by almost 65%. That's really significant. And if you keep rolling from one 1031 to another, you may never have to pay the tax if your children inherit the property, and they can often apply for a stepped up basis and start the whole process over again. It's actually a beautiful thing. Some people have deferred the payment of taxes to the point where they've amassed a small fortune. Now, let's open it up for questions. While we're handling the questions, we have a short poll we'll put on the screen. If you don't mind participating in our poll, we'd really appreciate it. It helps us kind of get a pulse for where you're at and what you're interested in, and gives us a chance to see how we can make our presentations better. So, Steph, I think she's put that poll up, haven't you? Okay. So let's answer the questions. And we put on the screen here a little information about how to contact us. So Brittany, why don't you read our first question?
Okay, question number 1 comes from Freddie. When you buy the new property or properties, what amount do you use, the original purchase price or the sales price at the time of sale?
Okay, you use the sale price at the time of sale. As we showed in that example, when you use the original purchase price, you wind up having depreciation, and that affects the adjusted basis. And so your basis in the property is going down quite a bit. So you wouldn't use that original purchase price. You're going to use the price that you sell the property for.
All right, the next question is from Carl. Can a 1031 replacement property be in a real estate fund?
Carl, I'd like to ask you what you mean by a real estate fund. Do you mean a real estate investment trust? Or do you mean that you're doing a 1031 and you're trying to put it into a fund, and that 1031 is acquiring part of the fund ownership? And I'm guessing that's what we're talking about here. And that would not be considered a like-kind exchange. So if you are doing a 1031, it's got to be you're purchasing real estate. You're not purchasing an interest in a fund.
Okay, the next question comes from Maggie. More about selling and buying in the same name, please. I am relinquishing as part of a partnership, but wanted to buy new property myself, but sounds as though that is a violation.
It's not really a violation, but so you're doing basically a little bit more complicated transaction where you have 2 or 3 owners in a property and only one wants to do a 1031 and the other 2 do not. So you'd get with your qualified intermediary. You took your ownership in that partnership in a specific way with a specific title. And so as you're coming out of that, if not everybody is participating and it's just you, whatever title you used when you bought that property is the title that you will use on the new property. You don't have to use a partnership name necessarily. You have to use the title that you took possession of the property in.
Okay, the next question is from Jennifer. Is there a limit or number of transactions that can be done within a 12-month period or any given time frame?
There, to my knowledge, not a limit on the number of transactions that can be done. But to be honest with you, I'm not 100% sure on that. I haven't seen somebody trying to do multiple 1031s within a 12-month period. There may be some limitation on that, but these things, I'm just giving my general sense of how I would react, and then we'd have to do more investigating and talk to a qualified intermediary. But each one of these are property specific. So if you were, say you own 4 or 5 properties and one was in Georgia and one was in Florida and one was in Texas, and you decided you want to sell all of those, I think you would take them one property at a time, or you could take all 3 of those properties that I mentioned and invest them and do a 1031 into a new bigger property that was of equal or greater value. So I don't think there's a limitation in that regard, but you might want to check with QI to get a more definitive answer on that.
Okay, the next question is from Philip. Is there any strategy you recommend to make the qualifying days work out, like the 45-day and the 180-day, like put an investment under contract and then listing the relinquished as at an aggressive price point?
Well, you can put a property under contract before you sell your old property, but you want to make sure that the closing wouldn't occur until after you've sold that property. So it might be a timing issue that you're dealing with, but you do have to stay within the 45-day period and the 180-day period. So you definitely want to get a jump on identifying the property that you're going to use before you sell. If you think it's going to be a long time, I mean, you mentioned here that you want to sell your relinquished property at an aggressive price point. I don't know what that means. If that means you want to be aggressive by lowering the purchase price or aggressive by increasing the purchase price, which obviously you lower it, it's going to sell faster than if you raise it. But it's just a timing issue.
Okay, Maggie had another question. I'm not clear on intermediary fund. I attended a class where tenants in common was purported to be acceptable for 1031.
Okay. I didn't mention anything about tenants in common. They're called TICs, and you usually have what's called a TIC agreement, TIC agreement. I do these all the time. They're a little bit more advanced than your typical 1031, but there is no problem using a tenant in common when you do a 1031. So let me tell you a little bit about how that works. This is the the closings that I did yesterday. So I owned a piece of land that were approved to build a 116 unit apartment complex on. And I had 4 different 1031 owners that wanted to get into this deal. And so each of them bought a percentage ownership in the land. And then we formed a tenant in common agreement where each one of these 1031s was a co-owner. And they are partnering with the LLC that is raising most of the equity capital to do the new development project. So yeah, so you can, I don't view it necessarily as an intermediate fund. You're buying real estate, but you definitely can use a tenant in common agreement, and everybody can work together in a transaction like that. Maybe I'll have another webinar where we'll talk about more advanced 1031 concepts like the one that you just presented.
Okay, the next question is from David regarding replacement property. If you want to make improvements to replacement property to bring the value on replacement property price equal to relinquished property.
Okay, so it sounds like what you're wanting to do is buy a property that is not equal to or greater than the value of the relinquished property that you're selling. But you think if you do the replacement, if you do improvements on the property, that will bring the value up so that it'll qualify for the 1031 exchange with no tax consequence. The thing that you'd have to be careful of in a transaction like that is you have to make the improvements within your 180-day window. So you could buy a property and make the improvements and then do your exchange so that it qualified for the equal or greater than value. But if you don't do something like that, then you might have some issues.
Okay, the next question is from Jennifer. With regard to the 200% rule, if I have a property that is sold for 280 and I want to replace it with an investment property that is 600, can the 280 be used as a down payment?
Absolutely. So that isn't a problem at all. You can buy properties that are significantly more than the property that you're selling. You wouldn't necessarily use the 200% rule. Usually the 200% rule is used when you're aggregating several smaller properties together and you're taking all those properties to come up with getting the right value for your 1031. But if you're actually using your $280,000 1031 to buy as a down payment to buy a $600,000 property, then most likely they're going to buy a percentage ownership of that property. They may not own the whole thing, or they could own the whole thing, but yeah, that would work just fine.
Okay, the next question is from Philip. What is the best way to find a good intermediary? What are typical pricing structures?
Typically for a qualified intermediary or accommodator, most of those are some of your national title companies. First American Title, for example, has a company they call First American Exchange, and you find, and some of the banks have qualified intermediaries, so you have a variety out there. I think you could just easily do a Google search and find a good qualified intermediary. And in terms of pricing structures, I'm guessing what you're asking is what are the exchange fees that are usually charged by these companies, and it's relatively nominal actually. Usually it'll vary between $500 and $1,000. Some are a little bit more if the exchange is bigger, but you're somewhere in that range.
Okay, the next question is from Maggie. How long must one continue to use an acquired property as an investment property before you can convert it to personal use?
Okay, so if you decide that you want to convert it to, there are different schools of thought here, okay? From a technical standpoint, in my opinion, as soon as you convert an investment property to personal use, then you're going to have to pay the gain on sale, and that has been deferred. But I've had some attorneys tell me that if you've held a property for a year or 2 years, you could then fold it into an LLC or something like that, and your 1031 kind of goes away. The adjusted basis still stays with you, but I'm not sure if you've decided instead to totally get rid of the investment purpose for the property and turn it into personal use if you're not obligated to pay a tax. Well, that's a bunch of great questions. We appreciate the time that you've taken. Hopefully you learned a lot, and we can get together on another webinar, maybe on an advanced 1031 or something else. We appreciate everybody attending. We had nearly 100 people sign up for this, so thank you for your questions and look forward to seeing you on another webinar.